I am not David Dapp. My name is Ed Morris. David is on a deadline in the world of journalism when he's dealing with Iraq and oil balances, and when his main editor for his publication just decided to leave Energy Intelligence Group. He's been snowed with work, so he apologizes for not being here. The other apology is that Bob McGuire, whose name is on this table, is also not with us. And I just called him to find out where he was, and he's in London. So I guess he's not going to be with us, and he said he could join us by telephone, but I didn't know how to do that through my cell phone. So we'll make this a little bit more informal than it otherwise might have been. And without Bob's presence, we're going to be skewing the subject, given who we have on the panel, with Catherine Spector from CIBC World Markets, where she runs commodity research, and Bob Lemon, who is at CME Group, also with a similar function that Catherine has. Both of them tend to look at investor flows through various financial mechanisms rather than financing itself. I probably will add some ad hoc observations on energy financing as described in the descriptive paragraph on what this panel is all about after their presentations. And I'll try to make it a little bit more coherent in making a transition between a look at financial flows on the one hand and looking at the trillion-dollar question of financing energy sources of supply, energy uses of supply, and in both the upstream, downstream, and utility sector. So we'll start with Catherine, and then go to Bob in the order that they are next to me, and then I'll make some concluding observations before opening it up for discussion. Thanks very much.
Thanks very much, Ed, for that introduction. What I'm going to talk about today is based on a report that I published at CIBC about a year or so ago that we call the Post-2008 Commodities Trade Market Liquidity in the 3 C's. And for us, the 3 C's that have really defined the post-2008 trade is clearing, correlation, and credit. So I'm going to talk about a few of the themes that we discussed in that report. A year later, a lot has changed in these markets again, so we're actually thinking about doing an update of this report. If you're interested in reading the full report, I'm happy to distribute that, and certainly appreciate any feedback as I think about the next version. All right. In the context of this report, our main thesis was that while price discovery in the commodity derivative space has absolutely increased very significantly since 2008, what we would define as true liquidity, if anything, has actually deteriorated. And I give 2 definitions here that are not necessarily technical definitions, but are definitions as I am using them in this report. So for me, price discovery is the rapid, transparent, and non-preferential access to price information, which now with everything on the Bloomberg screen, everybody has all the time. And liquidity I've defined as the ability and willingness of market participants to execute volume and manage risk at a price from both a market and credit perspective. And that's sort of a broad definition of liquidity, but that's what we're arguing has deteriorated since 2008. So to frame this discussion, we divided up the historical market into a few categories. So we look at the pre-2003 market, and 2003 is when everything really started to change for the first time in the derivative space in a big way, and that's what eventually gave us our run up to $145 crude oil. Then we look at the period from 2003 to 2008 when we had that big price move, and then post-2008. We also classify the market participants as either buyers or sellers, and more importantly, since 2008, as either providers of liquidity or users of liquidity. So just to give you an idea of who we're talking about when we try to classify all these participants in the way that they affect And it's a sort of a lot of information very briefly, and the report obviously goes into more detail about how each of these participants actually touch the market. But just to give you a quick rundown, the energy producers and consumers are traditional energy derivatives markets. They were there before 2003, and they're using derivatives to hedge their business price exposure to commodities prices. Now, one thing that was quite notable in the 2003 to 2008 period is that producers got quite quiet. So producers weren't doing as much hedging as they had done traditionally. Whereas as prices increased, consumers got a lot busier in the hedging space. Now, since 2008, we've had another real sea change in producer behavior in particular. Producers are back to hedging, and I would argue they are back with a vengeance because the types of producers that tend to do the most hedging are the types of producers that have been very involved with the production boom that we're seeing now in North America. So whereas the national oil companies and the oil majors tend not to do a lot of hedging, if any, small caps, independents, those smaller companies that are very active in North America, traditionally are the bigger hedgers. And that, of course, those are the companies driving this boom. So as the amount of oil that they're producing has grown, and gas, the volume of hedging that they're doing has also increased since 2008. Now, some of these, the next two categories here are intermediaries in the market. So you have your financial institutions, your banks, which historically were sort of the middlemen between producer and consumer hedging. Now, in 2003-2008, particularly after the Enron crisis, when the trading houses and merchants exited the space to a large extent, banks came in and filled that role of market making. Now, of course, that revolving door has gone around again. Banks are out. A number of banks have exited the space entirely, and if you look at the sector as a whole, bank VAR is down significantly since it peaked around 2008. Trading houses or energy merchants are back. They're back in a big way, not only in the physical space, but also in the financial space. Now, one big change really just quite recently is the rise of the CTAs or algorithmic or systematic traders. Now, they existed, they were around in the 2003-2008 period, but their activity has increased significantly more recently as clearing has become such a dominant way of trade in the market. Now, one important thing here, I've labeled each of these participants as either users or providers of liquidity. And for CTAs or algos, I've put neither question mark. I think it's safe to say that while the CTAs provide liquidity on an occasional basis for short periods of time, they are not consistent providers of liquidity in the market, and that's an important shift, particularly as we see the macro hedge funds becoming less active in the market. So macro hedge funds have increased their allocation of commodities significantly in the 2003-2008 period, and it also become a lot more professional in the space. So whereas before 2003, you might see a macro hedge fund in commodities where you have a fixed income trader putting out an oil trade once in a while, in the 2003-2008 period, you saw a significant change where hedge funds were hiring career energy traders to trade those portfolios. Since 2008, we have seen a significant reduction in the allocations that macro hedge funds are making to commodities, we would argue, and also change in the way that the remaining hedge funds do trade the commodities. We think that their risk exposure has become much more short-dated on the curve, whereas in 2003-2008, hedge funds were actually very big providers of liquidity, particularly in the long-dated part of the curve, and that's gone away to some extent. Finally, you have the institutional investors, pension funds, real money accounts. They were the big new thing in the 2003 to 2008 period. That is the advent of commodities as an asset class. People started to look at commodities as part of a balanced portfolio the way they look at equities or bonds or other asset classes. This really was a big deal for the market because particularly at that time, those flows of money were very one-directional and tended to be passive. They came in and stayed as opposed to going in and out. Since 2008, and I would say really in particular in the very recent history, so this year, maybe second half of last year, we have certainly seen flows into commodities slow from this segment of the market, and in some cases we've seen reallocation away from commodities towards other asset classes, I think particularly since the equities market has picked up. Another sort of subtle change there is that whereas in 2003-2008 there was a real proliferation of products available for these types of investors, what we've seen since 2008 is a move back to what we would call vanilla beta, so simple commodity index, sometimes opportunistically with some alpha overlays. Now, what impact did this have on the market? This is a change that we saw in 2003, 2008. So if you look way at the bottom there where that yellow band is, prior to 2003, we had mean reversion in the oil price to about $18, $20, depending on whether you're using WTI or Brent. And that meant that wherever the spot price was, if you went far enough out on the forward curve, it would always come back to about $20. So when we were at an $8 crude market, the curve sloped up towards 20, and when we were in what used to be considered a bull market, $30, $35, the curve sloped down towards 20. So I would argue that in 2003, the most interesting and difficult to explain thing that happened was not that oil prices spiked up to such a high price level, but that those high oil prices occurred, for the most part, in a contango market, and that's something we've never seen before. So in other words, it's not just that the spot price moved up so much, it's that the entire curve moved with it in a fairly parallel fashion. So it totally dislodged from that $18 to $20 band. Now here's another way of looking at that. In the chart on the left, the gray line is showing the front month crude price, basically the spot price, and the blue line is showing the forward spread. So when that spread is positive, it's in backwardation. When that spread is negative, it's in contango. So if you look at the pre-2003 period, those two lines always move together nicely. We saw backwardation of bull markets, contango, and bear markets, and they moved together quite well. In 2003, those two lines diverged. And at the time, a lot of people, I remember, thought that looked like a great trade idea. Because here's something that never ever happens, and surely it has to go back to the way it always has been. Well, it didn't. Those two lines got further and further apart. And if you look at the scatter plot on the right, it's showing the same idea in a different form. The gray area there shows the decent positive correlation between spot price and flat price, and the blue shows complete statistical noise. No relationship at all. Now, here's what happened post-2008. The first thing that happened is that those two lines came back together. So they reunited. We now, again, see flat price and forward spread moving together. We added in pink on the right the scatter plot for the post-2008 period, and you see the relationship is back. The direction of the relationship is back, and in fact, the R squared is actually a bit better than it was pre-2003. The difference, of course, is the intercept. Whereas we used to see a flat curve or zero spread at about $20 oil, we now see that at about $100 oil. Now, I think it's a bit early to sort of call that our new mean reversion level, but in a sense that is what this data is telling us. The final point I would make here is that in the most recent period, really just in the last 2 years or so, we've actually seen the long-dated WTI spreads really outperform spot price. So those two lines move together again, but the spreads have actually outperformed. In other words, in the long-dated part of the curve is more backwardated than we would expect given what flat prices are doing, which over the last couple of years has been a whole lot of nothing. Spot price has been very, very range-bound, but we've seen those long-dated spreads outperform. I would attribute this almost entirely to the shift in participation in the market and the rise of producer hedging, particularly in WTI in North America, at the same time as liquidity in that deferred part of the curve has deteriorated as banks have exited and hedge funds are taking less deferred risk. So I sum up all these implications in 3 categories, and I'll just leave this to sort of set the stage for our conversation afterwards. But we call it credit, which we can also throw capital costs in there as well. Correlation, which is now actually going away again, so that story is changing again. And then centralized clearing, which I think we may hear more about today as well. So I will leave it there and look forward to your questions. Thank you.
Greg, thanks to IAEE for inviting me. Thank you for showing up. I don't know if you know the background of this panel. It certainly had some interesting, I don't know if I call them challenges, but first, at least for me, I got an email from somebody, Ben Schlesinger. Many of you may know him, and he says, you know, Bob, we're going to be in New York. It might be timely to do something on what's going on at the exchanges. And speak to that, and can you join the panel? And Dave Knapp, I think it says Knapp there, is going to share the panel. And Ben says, oh, I don't really have to prepare anything. So then Dave Knapp comes into the picture. This is Dave Knapp, you know, the K is silent there, right? It's really symbolic. I mean, I know Dave for many years. I didn't think about it until recently. And Dave is going, he contacts us a few times along the way, and he says, hey, you don't really have to have too many slides. It's going to be a panel discussion. About 2 days ago, this mysterious email, which I think Ed explained very well, it goes, Dave Knapp disappeared. So along with the K, you don't pronounce his last name, he disappeared. We come in today, of course we hear one of the panelists is in London, and at least he was nice enough to ask us to join us from there, but he's not here. And then we've got, Catherine explained to me that some earlier version of the schedule had this beginning at 10:30, which she didn't know had been updated. She just by happenstance saw it. So, might have just been you and me, and I got a hunch if you had seen that, there'd be a lot less people in here right now. So, thank you for at least staying so far. So this is a little bit of a Bermuda Triangle experience. Ed, of course, is always good to have, even though I think some residents are going to see if we can move. It will become evident as we get into this why I call this charts in an exhibition, but just want to, there we go. But first, I just want to, sort of keeping with some of the guidance I was given, I want to talk a little bit, this is a very interesting page, let's stay here for a moment. What's going on in commodity space, sort of with products and things like that. There's a lot of interesting things going on in the world. Catherine spoke about price discovery. I won't offer a different definition, but in terms of price discovery, there's been issues out there, especially in the oil world, for a long time. Two sweet crude references dominate. What about Asia? And that still is one of the issues out there. Will Asia happen to emerge and have some sort of price reference? Now, of course, in Asia, they're looking at other things that are very important, such as LNG, and are they separating from oil? We're going to have LNG price itself. These are issues that are out there, and there's definitely our efforts to try to address them. I'm not going to tell you anything more, just saying these are some of those things that are lingering out there in terms of Asia. The Middle East also has a lot of oil and other energy products, and there is a pricing tool there, the Dubai Mercantile Exchange, CME Group, which I'm part of, and Legacy NYMEX, which CME Group bought NYMEX about 6 years ago. But we have a significant stake in DNB, so I am biased there, but they offer Oman Futures product, which at least is sour and is waterborne. And also it trades at 8 or 9,000 or 8 or 9 million barrels a day, or 9,000 contracts a day, and it delivers about 10 million barrels a month, which is a little bit unusual for futures contracts. Clearly a very reliable delivery mechanism. And that seems to be emerging and slowly but surely getting more importance in the market. There is talk about changing reference pricing in Northern Europe because they're running out of production. They have to substitute other types of oil. And you've got it in the U.S., and Catherine mentioned it, but I don't think it was news when she did with all the new developments in production in the U.S. and in North America. There is talk, will there be Gulf Coast sweet? Even a Gulf Coast sour that starts to get more traction as a price reference. So these are the types of things going on in the market, along with in North America, if you're natural gas oriented at all, is the Northeast going to develop as a more significant pricing point on the Marcellus? Those are some very important issues. In addition, this may come up, depending on how discussions evolve, there's a lot of changes in regulation. The U.S. certainly applies, for the most part, in my view, more regulation than the rest of the world, but Europe seems to be catching up, and interestingly enough, now that some of the Europeans are getting a taste of that, at least some of them are starting to react kind of strongly and saying it's either going to sneak off to Asia and perhaps escape some of the regulation there. We'll see if that takes place. I can't really predict how much that will. I will tell you that regulatory arbitrage is pursued as active as any arbitrage that's out in the marketplace. So it should not be a surprise if they do. Now, with no further ado, I will get into the charts of the next edition. You can decide how much interesting you find it. I hum the tune from pictures, but I keep confusing it with another one, so maybe that's a benefit to you. Right here, most of the data I'm going to have here is all from the CFTC's Commitment of Traders Report, weekly presentation, and this is actually the number of reportable traders in the NYMEX crude oil contract. We have 1,000 energy contracts. We have a lot of oil contracts. We got a couple of dozen or so related, at least a dozen or so related to the WTI. So there's no shortage of these contracts, but this is just basic futures because that's what most people are familiar with, and I thought that would be a good one to look at. And I'm not really intending to contradict anything you just heard, but there are sometimes perceptions, gee, are things changing, are people leaving the marketplace? At least the number of reportable traders who are responsible for about 90% of all the open positions, I don't know that I can say that over the past bunch of years that we've seen any meaningful change in that. But that's not the only thing. But I thought I'd give that type of statistic. This is a little different. It breaks it down by the categories the CFTC has, and people can come to their own conclusions. I think the producer merchant is in the kind of bluish or purplish. You can decide. I'm not so sure we've seen any, really sea change there in the number of reportable position holders. This isn't positions, this is position holders. I sort of broke it up that way because I thought that would be useful. The swap dealers are in red. I don't know that you see major change there, and actually the managed money, it actually seems to have increased somewhat over the years. Now we go to natural gas over time. More recently, we've seen a drop in total number of position holders, which, who knows, there may be, if it's a policy ramification, possibly not, and something a little bit more subtle that is specific to natural gas, if it is that as a reason. But overall, we haven't seen a real significant drop there, at least it's so notable to me, but maybe we'll see how this contract continues on. Once again, the managed money seems to have increased the, actually the commercials in natural gas, I think you could say we've seen a little bit of a decline over the past several years, and that might be really that more subtle issue I was talking about. The swap dealer seems to be about the same. Now, I've written this in a particular way, so you know it's crude oil positions per reporting. And the reason for the different categories, because the way the CFTC reports it, you don't actually know the number of reportables. And I should have mentioned that for the different subgroups. For the total, for the market as a whole, you know the number of reportable customers. And just to step back, what does reportable mean? It means that they're above a certain level. I don't remember off the top of my head. I think it's 300 positions in crude oil or larger. Okay, so that's what constitutes reportable. As I say, they are responsible, or they hold most of the positions in the market. In natural gas, I think it's a lower level of positions. But all others are not reported to the CFTC. And the CFTC are the ones who categorize them into these categories. They're the ones that assign them. They might ask the exchange what we think, our market regulation department. They might, but they don't have to. You might, if you knew who this they were referring to, you might put them in a different category. Okay, I don't want to, but we don't know because they don't have to tell us. And I mean, I think they're very honest about it, and they do the very best, but it is a judgment. Here, it's the number of positions in the category per what's reported, and for all the subcategories, I just had to add all of those different when it was short and long, and sometimes they give you spread. I had to add those together as the number in the market because they don't tell me the total number, okay? So that's what this is. But once again, it's just another measure. The average number of positions per reported doesn't seem to have changed a lot, or all that significantly in oil. I mean, it actually seems to have gone up in the producer merchant category. Natural gas, kind of similar. There is a rise in some, and I think there's a drop actually in the swap dealers now, but that's in natural gas, okay, not in oil. I mean, maybe we'll go back. In oil, I don't, in the swap dealers, you don't really see that much change, okay? But in natural gas, it does look like it's dropped, but that could be related to volatility. This last table, by no means was this a supercharged analysis, but one of the things that I thought, why don't I look at just volatility, which took off, we'll give them. And in this case, I think we got the volatility from Bloomberg, how they analyzed it. I don't know if it was 20-day or 30-day. It was historical, it seems to be. And I simply said, well, why don't we regress the reported number of participants in these different groups against that, see whether it's significant or not, and what the R squared was. Now, for those of you who are a lot more technical than I, you would say, well, if you lagged it, what did that do? When I lagged it, it was, that's itself, it does make the R squared jump up significantly, but the variables, the T statistics did not change that much for this variable, which is why it's left it like this. It's interesting, it's a negative relationship between all these. This means as the market got more volatile, you had less number of participants, which is a little bit counterintuitive to me, and it's sort of interesting to look further, probably explainable. I'm not so sure that's related to the trend in the market, but possibly it is, but I don't think that is. But it's across the board we saw that. So, well, you can see we ran out of charts, so we're done with charts for the exhibition, and I'm also done with my presentation. Thank you very much.
Thanks very much, both of you. I found it intriguing to look at both of your sets of charts at this exhibition, and Catherine's look at the period 2003-2008, and then look at what Bob said about what was happening for 2008. One of the strangest things, if you look at those two sets of charts together, is as oil prices went up, and you'd think liquidity in the market went up, the number of reportable traders actually plummeted to its lowest point before the market dropped in July 2008. And I'd like each of you to kind of, if my observation is correct on those charts, to try to explain that. Just kind of filling in for what I think Bob Laguardia was going to talk about. During the period 2003 to 2008, well, a lot of things were clearly happening in the market. The amount of capital that went into real investment and exploitation of oil and gas escalated dramatically. So we start the period 2002 with capital in real terms going into the 6 activities that are involved in the upstream. Getting acreage, undertaking exploratory drilling after doing seismic work, doing development, drilling after doing evaluation of whatever discovery was, and extending lives of fields. 2002 had actually a lower number of capital deployed on those 6 areas than 1981 did. And then by the time we get to 2008, there was a 6-fold increase in the amount of money that was put into finding and developing oil and gas resources around the world. And that number, CapEx, has not, other than a brief period of time and not very dramatically, when oil prices plummeted in 2008-9, there was a little bit of a retreat, around a 9% retreat in capital deployed for finding and developing resources. Other than that minor drop every year since has seen an increase in capital employed. Whether that has to do with interest rates is an interesting issue to try to think about, since we are globally in an incredibly low interest rate environment, which perhaps has propelled that and extended the capital deployed. But I just wanted to put that on the table to open it up as a possibility and something that some of you might want to talk about. So if you have questions, you want to start a discussion, take the mic and let us know. And while somebody may or may not be walking up, I wonder whether you, Bob and Catherine, could reflect on my observation about it, about what I saw and looked at your slideshows.
Sure, Ed. I think that what you noted, I mean, is very possibly something that really did occur, and certainly the market, when prices get higher and there's greater volatility, the collateral requirements go up. And as collateral requirements go up, sometimes participants have to lower their positions. There's other elements of that too. Sometimes the amount of authority that parties have to participate in the market for whatever purpose may also be related to a certain kind of nominal value of the product, and of course as prices go up, that may also diminish. So there's a couple of reasons that could occur, and sometimes, ironically, when volatility just goes up, there's just because of the risk, even just general, that's associated with it. Though hedging is certainly something parties want to do, locking in something with certainty has its risks too. So it's, I mean, those are the types of things that can contribute to what seems a little bit of a paradox to you. And I think we've seen it at other times, and so it's not, I think, specifically unique to that period.
Yeah, I would want to look a little bit more closely at exactly what the timing was, because obviously there were a lot of moving parts at that time. But one other thing that I would add is that the financial crisis sort of predated the oil collapse. So in other words, oil prices were still very high when all of that started, and other asset classes started to fall. So I think that anecdotally, one thing that we saw was that in some cases people took profits on what were still profitable commodity positions to essentially raise capital against some of their other failing positions. So where there was a multi-strategy involved.
Hi, thanks for the presentation.
Rather than my introducing you, would you like to tell us who you are?
Yeah, I'm Mike Lynch. I'm just a pundit. I'm a little curious because there's been a worry for years that the trading would all move overseas and be less regulated. And I'm curious, what do you think might cause that, or is it inevitable that would become more of a factor? And what do you think would it mean for the trading, the risk, and the price to have it going on in other places?
Yeah, I think Bob's going to answer that since he talked about regulatory arbitrage. I'd just like to make a note about Bob focusing on his disclaimer for a while. All of us have disclaimers. And Adam Smithy used to, when he made presentations, say, look at the disclaimer. It means you don't have to believe a word that I've said. And please don't make any investments based on what I've said, because I don't take responsibility for it.
I might have to add those 2 lines to my disclaimer there. Thank you. The regulatory arbitrage really does occur, and it's an issue that's important. And I do think the regulators, both at the politically appointed level, the commissioners, as well as the staff, they're aware of it. It's not that there's no concerns, but there are other things that prevail as well. And these have been, especially since 2008, some of the issues have definitely been politicized. It's, I think, a little bit unfortunate for commodities, just in the context in that it's not, I mean, I don't believe, and I haven't really seen anything remotely convincing that commodities were at the heart of anything or experienced some of the things that really stood out as the most concerning from the financial upheaval. But they got put into that category probably in the U.S. because oil prices in particular were high, and that sharpens the kind of the political background. And even I can remember, and I don't know who said it, but some senators in talking with the head of NYMEX at the time, I think the metaphor they used about when they said, look, you may not like the points we're raising, the things we're saying, but it's the people with pitchforks that are lining up behind us, okay? So, I mean, they were really just saying and representing kind of that public frustration. The American public doesn't, generally speaking, want to understand how these markets work as well as all of you, which is perhaps why some more seats are not filled today. It's too bad because they might benefit, not so much for me, but just from that sentiment. Having said that, it's a concern if activity moves overseas in terms of arbitrage, it does mean there's less liquidity and probably less transparency. One of the things that nobody should ever overlook is that participants in these markets, many of them do know how to benefit from less transparency. I'm not saying they're seeking it. I'm not saying that there's some sort of ultimate goal, certainly no conspiracy to cause it. But they know the value of their product. They know their market. There's dozens, if not hundreds of companies like that across the world that are well positioned to benefit better. And when we push it, whether inadvertent or even if inadvertently, when we push activity outside the sphere of the kind of the public regulation and transparency, especially in the U.S. markets, that's a cost to everybody. I mean, one of the other things about the U.S. markets that really stands out in sort of hand in hand with our transparency and our liquidity is that the U.S. government provides an enormous amount of highly reliable information on energy markets and just the energy industry and underlying fundamentals that are important to that industry, including its valuation and the valuing of it in the market. There's nothing like it in the rest of the world put together. They just don't. I mean, the U.S. provides a lot of information as of last week. They do it every week, and they provide stuff as of just a couple of months ago. When they do it, you don't see the heavy revisions you see for things that are provided on a monthly basis with a 2 to 3 month lag elsewhere in the world, and heavily revised sometimes. So that, you lose that benefit too, because they're reporting mostly in our markets, but our market, more than ever, is integrated with the rest of the world. In oil, it's very obvious now that between petroleum products and that we're exporting and the lower imports of crude, we put in about 4 million barrels a day of oil into the rest of the market. The U.S. is part of that world oil market. Nobody, I mean, maybe somebody will want to argue against it, but that's a lot of oil out of 91 million barrels a day. Natural gas is not quite there, so I'm not going to say that, but let's see how that unfolds over the next couple of years. And once again, our markets are really well reported on in terms of fundamental information. So I think that's another, it's more than one aspect that I think is hard.
Catherine, did you want to make?
I guess I would just add 2 other perhaps unintended consequences of financial market regulation. One is we have seen a shift of banks out of the space. They were major liquidity providers, and to some extent merchants have taken up filled that vacuum, if you will, and whether there's a transparency trade-off there or not, I don't know, we'll find out. And the other is that there is value to unique information, and I think when more trading was over the counter and less was cleared, there was some unique information in those flows for people trading. And that unique information doesn't exist anymore. So we're seeing people seek unique information in other ways. And one way is by, for example, acquiring part of the physical supply chain. And I don't mean to imply that there's anything nefarious there. It's just a different way of approaching the market and finding a way to develop proprietary information based on physical assets you own. So again, I'm not implying that that's good or bad or nefarious in any way, but it's a change in the market that was perhaps not the intention of the regulation.
Mike, I'd like to make one other observation about your question, because I think the major problems that have emerged in financial markets are kind of China-related, and we saw it recently in Qingdao, where there was over-leveraging on metals. And clearly in China, commodities have been used as a mechanism for financing other kinds of things because of the ability to borrow against inventory at a lower interest rate than one can through the financial system directly. And it has certainly created less transparency in the market, and we have blow-up. And as a result of the blow-up, people were arrested, and the Chinese government, at least, has taken on the needs for transparency and regulation. So to the degree that there was deception of real assets, real copper, real aluminum, into China in a frenzy to borrow against it, problems emerged that probably will end up with better, more transparent regulation.
Yes, I'm Mike Keynes with the Logistics Management Institute in the Washington, D.C. area. So a question for Bob Levin. So I'm sort of thinking about the regression results that you obtained, volatility on numbers of market participants, when you divide it out. It's kind of surprising result maybe. So I was curious, but I couldn't tell the time period over which that regression was run, but I was wondering whether maybe if you divided the time period, sort of, say, two halves, you might get something that would look like, that the market has changed in some sense, volatility has changed in some sense, and market participants think, hey, I need to kind of look at this for a bit. I'm a little worried about what this really is, what's happening here. But then over time, they begin to see sort of a new pattern, let's say, and they come back in. So possibly, if you could divide the period, you might maybe get a little different result. Don't know.
I suspect we would certainly get more insight, and indeed we might. I can tell you, I mean, a lot of times I'm really interested in showing there's something different happened. I mean, one can at least hypothesize and say, gee, if there's a certain regulation that maybe we think could have been formulated better, we might look before and after. So you can see in that kind of circumstance I do it. There's other reasons I would do that. The thing is, whenever I've done a Chow test, they're always so remarkably, every period I've chosen has been different that I kind of realized that I'll always get that. I think you're right that there would be more insight. This was over, there were 416 observations, which I think is about 8 years. It goes up to this year. That's a long time. That covered a lot of things. So the value of that is it shows if you think, gee, I think maybe this guy up here made a decent point, then there's a relationship there. But everything you just said, I think you're absolutely right. And it would be very sound to go further into the look. And what can I use as an excuse? I was advised several times not even to have slides today, so I was sort of, if you'll accept that.
Doug Reynolds, University of Alaska Fairbanks. I'm visiting here in New York City. I think it's the second time, and I'm from Fairbanks, and it's very overwhelming coming here, and it's complicated, and it's busy, and so likewise, I'm a very simple kind of person. I don't know what's going on with finance. So I had this question. Before the financial crisis, or the lead up to it, they had these collateralized debt obligations. It's kind of a new, it seemed like it was a new kind of financial instrument. And I know there's other new kinds of financial organizations, different things, LLCs are new, kind of relatively new and so on. So I was just going to ask, is there Is there some new instruments, some new organizational things that are happening in commodities markets and energies, if you know of any?
You know, whenever anybody introduces themselves in kind of that, aw shucks, it's really complicated here, I do make sure my wallet's secure. Possibly from working in New York a lot of years, because I'm not really a New Yorker. Although people figure out the pathology of somebody who can work here for over 20 years and say they're not a New Yorker. But there's always some things that are different, and there's things that are the same. I referred, I mean, this is hypothetical, but it's out there sometimes in talk about the trade press. Will there be some sort of new tradable product that emerges, sweet crude from all of this new production, this higher API gravity production in the U.S. mid-continent, be it Eagle Ford, South Texas, or Permian, or the Rockies, or Bakken, and parts near all that, and that might happen.